quite a bit going on globally that India is reacting to, of course. There is, like I pointed out much earlier, data that has come out from China, which will also go on to impact something like our metal stocks, which pretty much react to how the China market really replies in terms of demand as well as supply. So that will be in focus. And let me navigate this conversation now towards the fundamental picture and what we have going there. And joining me for that is Anirudh Garg. He's a partner and head of research at INVasset PMS. Good morning, Anirudh, and thanks so much for speaking with us here at Money Control. Well, let me first get the broader picture, because we did have a bit of headlines that we could be reacting to, one of them being the ratings that has come from Fitch. Now, they have gone ahead and affirmed that BBB minus rating for India, which it had done before. But what is interesting to note is the fact that they've revised even the GDP forecast from what was 6% in May. Now it's revised to 6.9%. So does this give us some bit of relief in that sense, where we can say things are working out well for India?
A very good morning, Stacey, and a very happy new year to you. This is my first interview on Money Control TV this year. Stacey, at INVasset, we believe that ratings, which everybody gives, all these big rating agencies give, they have a very less correlation to what markets are performing. See, the India rating is BBB minus, and look at the China rating. So it's in A's. So, and look at the performance of what the stock market has done in both the countries, where we are hitting our all-time highs. They are taking out their COVID lows as well. So we believe that one should focus on what is happening in India's markets, and these ratings that these agencies give for us do not hold a lot of significance. We are more of a quant-driven PMS, and we believe that in the next couple of years, India would have a very, very great run in terms of the stock market performance. And yeah, we are moving into that expensive zone now, but there's still more left in the India story.
In fact, I was just going to ask you on that, really saying, if you ask analysts outside, 9 out of 10 of them say that, India, it's quite highly valued. So do you think there is a reason for that, or people should be paying for what they're going to see in terms of growth?
So when we are seeing at the valuations, we have to compare relative valuations. After the China fiasco, the investors, the FIIs are very, very clear that anything which is not a democracy, any place, any country which is not a democracy, it is a no investable zone now. Because you've seen what has happened with the companies in China and how the communist government there has, stopped their growth. And the entire story that was out there, that China would be representing Asia in the long run, India has also joined the kitty now. I was going through an interview of one of the most prominent Asia and emerging markets analysts. So his view was that India is being now run like a company. It is only Modi who can buy the cheap crude oil from Russia and then also get invited to the White House. So the dynamics for India have changed a lot. And that is why India is commanding this high valuations. And if we look at it historically as well, India has always commanded higher valuations than its counterparts.
Right. Let me also look at, from the policy perspective, we are expecting at least the Fed to be cutting rates sometime as early as March. And then we could, in fact, then also see the RBI take similar, moves. But how soon could that come? Because Fitch, in fact, in its report has gone on to say that they're looking anywhere close to a 75 basis point cut in FY25. So how soon do you see this happening, and how would that really play out in the Indian context?
Okay, so very interesting question, Stacey. Now, what has happened is that there is a rule in the market which says never doubt the Fed. But, all of us as analysts, as managers, as investors have a tendency to do the other way. Let's take a quick 3-year snapshot of what has happened in 2021, in 2020, when the COVID came and the Fed said that we are going to roll out money and we are not going to let our economy slip into depression. Everybody was like, COVID is here, and the markets would not perform and did not give any heed to what the Fed was saying. Secondly, when in 2021 the Fed says that okay, we have an inflation problem now, and I remember the results of companies like Tata Steels coming up to like all-time highs, and everybody was very bullish and extrapolating what results for the next 2-3 years would be. And now the Fed has said that okay, the inflation is over. Now everybody is extrapolating when will the rate cut come. I think it's just a decision. The Fed gives you an overall trajectory, an overall path, a broad path, and one should focus on that rather than when the rate cut comes. Stock markets, they discount the future, and rate cut for us is just an event which either plays out in March or maybe June. But yes, it's just an event in the future and does not hold a lot of significance. What holds significance is the broad trajectory that is out there. That inflation for us, and as the Fed says, is over.
Right. So inflation maybe not such a pain point, at least for India. We did see our numbers improving for the December number, at least coming in there at 5.69 or 5.7 levels, which was, inside that not comfort zone, but inside that 2 to 6% target that the RBI sets out. Anirudh, let me also ask you about the pharma sector. Now, that is something that also gets impacted, especially what we're seeing happen in China. That really, our specialty chemicals also in that sense have, seen a bit of run up now because they are getting that chance. Now we're just seeing China come out with its GDP number, which is in fact lower than what was expected, at least just coming at 5.2%. So how much will that China plus one strategy work in favor of India, and how soon can we see that really, showing in terms of not just our market with inflows coming in, but also which of the sectors are really going to benefit then?
Okay, so a couple of points here. Firstly, when we talk about China plus one is actually happening on a very, very large scale. You go out and talk to the companies out there. They are saying that they are benefiting immensely from the China plus one factor. When it comes to the pharma sector is actually a very shallow cyclical, I would say. It is not as shallow as the FMCG, but next in line. So I think the pharma sector, it is all played out, and pharma sector is in a new bull run now, though it would not be as strong as the other sectors which really have the tailwind with them, like capex and I would say real estate and all. But yeah, the pharma sector is in a new run. And when we talk about specialty chemicals, we are not very interested in the specialty chemical side, because what has happened in the last 10 years post 2013, when the chemical bull run started, a lot of capacity additions have been done. So with the capacity additions, there comes a time when there is too much inventory in the system, and they need like a 3-4 year pause in terms of settling things out, weaker hands moving out, the prices settling in, and the inventories being finished. As it happens, just to give an example, they are not the same as it happens in a steel sector or in any other cyclical sectors. The problem in India was everybody gave specialty chemicals or even chemical sector a status of a FMCG sector. Yeah, the multiples that they commanded in India were more or less of an FMCG sector. So that multiples, they need to be corrected with the price and time correction.
Right. So interesting view then, how one should really be looking at specialty chemicals, especially in this run up that it has seen so far. But my final question to you, Anirudh, is going to be on the aviation sector. And I'm asking this because of late it has been, making headlines for all the disruptions that we're seeing, fog causing some chaos, and most of our airline stocks pretty much making news for all the wrong reasons. We don't have one of the biggest player in terms of market share, Indigo being in the line of fire, one would say. But in terms of aviation and travel stocks, those were the ones that really did well all through what we saw happen last year. We had so many events taking place, right from the World Cup to the G20, all of that. But where are we seeing this going ahead? And will just these little bit of headlines that are coming in now, are there a knee-jerk reaction to what we're going to see the stocks do in at least a near-term future?
See, Stacey, the problem would have been if there was no chaos. I believe for airlines or any other companies, chaos is good. You are talking about chaos because people are traveling. This is aspiring India. 10 years back, when the willingness of people to travel through air and spending that extra bit is now much more. The disposable income of the people is increasing. They're opting for premiumization. Look at the airfares where they're going. The fares that went 10 years ago, which were around 5,000, are now around 12 to 15,000. So, and the crude is under control. The infrastructure of the airports is being ramped up. You're getting newer airports. The willingness of the customer is there. What else does what do our airlines need? So yes, I think we are bullish on the airline sector, as bullish as we are on the tourism sector.
Interesting to note that tourism as well as the aviation sectors are perhaps going to see more further uptick. We have events like even the Ayodhya temple opening, and all of that has seen quite a bit of interest among people, and that travel bug definitely here to stay, one would say. Well, let me thank Anirudh for giving us this perspective that he's brought to us right from the sectors that we could be looking out for in 2024, as well as the global picture and how India pretty much sits there in terms of its market as well as economy. Thanks so much, Anirudh, for giving us your time this morning.
Yeah.
Well, and to all our viewers who've been tuned in, well, doesn't seem like a very good day for the market there. Really sharp cuts coming in for both the Nifty and Sensex. Nifty there at the 21,700 odd levels, down by 1.19% odd. Even the Sensex taking almost 4-digit cut at one point there. We were almost 1,000 points down. Now trying to gain some bit of semblance, but 1% kicks. And of course, it is the banks that are clearly bleeding today in trade post those HDFC numbers, but we'll have to see where it really goes from here and whether buy on dips is a strategy you would want to implement, at least for the banking names at this point. But with that, we're completely timed out here on a Morning Bell. It is a wrap and goodbye from the entire team that puts this piece together. Thanks.